Buy the dip. No, wait. Buy the dip now. Hold on. Wait for it. It's dipping again. Buy now. If you've been on any social media lately, then you would 100% resonate with the madness that is currently going on in the markets. With the S&P 500 down almost 20% since the beginning of the year and all of the major tech stocks and crypto coins burning, it is a really interesting time that we are currently living in. So in today's video, I'm going to explore exactly what is currently going on in the markets. I will explain why people are reacting the way that they are, and at the end, I will give you my best strategy to come out on top of all this madness and tell you what you need to do as soon as possible. So, buckle up, grab a Simba chippy. It's going to be a bumpy ride. You know, because of all the dips. Oh, come on, man, it's funny. Okay, so unless you've been living under a rock, you probably heard about the war between Russia and Ukraine. Wars tend to drive fear into people's minds, and if people are fearful, they usually revert to safety. If we look at investments, shares and crypto are considered to be the riskiest assets when compared to cash and bonds. So if someone is scared or uncertain about the future, it is basic human nature to want to pull out their money from risky assets and put it into more stable, predictable and safe assets like bonds and cash. We've seen the same trend in March 2020 when the pandemic hit us right in the face. People panicked and the markets crashed. And due to the nature of the pandemic, many people have lost their jobs. And this just solidified the importance of maintaining a safety net in cash in case this ever happens again. So it is only natural that people want to cash out in case the war escalates, causing them to lose their jobs again, so that they would have at least something to live off of. And if there is a massive sell-off of shares, others who are invested in the same companies will also start to get scared. And in an attempt to minimize further losses, they might also sell off their shares, thereby feeding the runaway fire. And if we look at basic economics, there is an inverse relationship between demand and supply. If there is a lot of demand and a limited supply, the price for the product or service will go up. Likewise, if there is very little demand but too much of a supply, the price will eventually go down. Let's take Tesla as an example, which is also down by more than 40% since the beginning of the year. Last year, Tesla was all the hype. The share price was on a strong bull run for 3 years straight, and given the innovation of the company and Elon Musk as the driving force behind it, everyone wanted to own Tesla shares. Although the number of shares, i.e. the supply, remained constant, the demand shot up, which meant that the price also went up. This is what tends to happen to most growth stocks during a bull run. If the markets are doing well and everyone's portfolios are in the green, the overall investment sentiment is positive. People are confident and therefore more comfortable taking on more risks, therefore putting more money into riskier asset types like shares, and ultimately this will also drive up the share price even further. Now, the reason why I am focusing on growth stocks like Tesla, Microsoft, Apple and Netflix is because of the way that these stocks are valued, i.e. how their share price is determined. So their share prices are based on future projected earnings, meaning what we as investors expect these companies to earn in the following couple of years. If the markets are strong, then the overall sentiment is good and the share price will increase. The problem here is, if the markets have been running strong for too long, the share prices of these companies tend to become overvalued, meaning the share price is not an accurate reflection of what the company is worth at that specific stage. This can lead to a bubble, which if inflated too much will pop and the share price will drop like a disprin. Does any of this sound familiar? Another important thing to know is when the interest rates are low, companies can borrow more money for cheaper to help fund their growth, thereby increasing their future projected earnings. Now, due to the pandemic, the US Fed had to cut interest rates down in order to prevent an economic collapse, which was a golden opportunity for these companies to capitalize on. Unfortunately, this fairy tale period has now ended. The Fed is systematically increasing the interest rates, which makes it more expensive to borrow. So this obviously decreases the projected earnings and in turn the profits of most growth stocks, which means they cannot live up to their previous expectations, causing investors to lose trust and interest and therefore pulling out their money. And then on top of all of this, the war in Ukraine and the current lockdown in China are putting severe constraints on supply chains as manufacturing is slowed and deliveries are delayed. This results in stunted growth for big tech companies as they cannot access all of the raw materials that they need to produce the products or services that is expected from them, which again causes investors to lose confidence, therefore selling their holdings and ultimately causing the share prices to drop. Now, the most popular indices such as the S&P 500 and the Nasdaq 100 are both heavily influenced by these behemoth growth stocks. So if there is a massive sell-off of several of these growth stock companies, the overall value of the index will also fall. But because it is diversified over several different industries, it will be less negatively affected than most individual companies. Okay, so this was a very watered down version of many complex economic principles. But it is important for you to at least have a basic understanding of why it is that the markets are reacting the way that they do, so that you can make informed decisions instead of reactive ones. So this begs the question, Pieter, what do I do? What do I do? The first natural response to markets crashing is to sell off all of your investments to try and minimize further losses. And I get it. Seeing most of your portfolio in double red digits is not fun for anyone. I also bought a bunch of individual stocks right at the peak end of last year, only for all of them to become brutally abused, making me feel like a complete idiot. Bruh. But what is happening in the markets now is not really something new and definitely not something unique. We have seen many wars before, and there have definitely been similar market bubbles that popped in the past. But if we zoom out, we can see that the markets did always recover. Some crashes did take longer than others, but because of human innovation and the advancements of technology, the world will always find a way to move forward, and thus the markets will always eventually recover. If you remember, we were in a very similar situation just over 2 years ago, and if you were one of those who sold off your investments right at the bottom of the crash, you would have missed out on massive gains. After the markets recovered last year, people were bragging left and right about how well their portfolios performed, and you couldn't really open YouTube without seeing a video about the next hot stock pick. I know, because I also watched these videos and got a bit greedy. The truth is, a monkey could have thrown darts at random stocks and most of them would have performed well because the markets have been in a very strong bull run. So whatever you invested in, your portfolio had a very good chance of offering exceptional returns. But now the reality is the stock market will always correct itself. If it has been running strong for too long, it will have a mini crash or correction, but after a while the markets will again recover, which inherently will result in another bull run. The biggest mistake that you could possibly make is to sell off your investments at the bottom and then only buy back once it starts to recover. And I don't care how confident you are in your ability to time the market. History has shown us that not even the experts can get it right. So why would you? The biggest gains in stock market history has been right after a stock market crash. So your biggest risk is not the unrealized losses on paper, but rather by not being in the market when this swing eventually takes place. I've constantly been hammering on the importance of following a good long-term investment strategy since the beginning of this YouTube channel. And the majority of people will happily keep at it as long as the markets are doing well, but as soon as the markets go down, everything they learned goes down the drain and they seem to forget why they had a long-term investment strategy in the first place. And then they tend to blame their asset managers or financial advisors for their losses just because they don't really understand the reasons behind why their portfolios are down. You guys know that I am a strong advocate for learning how to manage your own investments, and that is why I created this YouTube channel in the first place. Because if you truly understand how the market and investments work, then you wouldn't be bothered for a second about this market crash. You would have done your research, set up an investment strategy that fit both your risk and investment horizon, and then just continued to contribute to your investments every single month. Okay, so if you are in the correct mindset of not selling off all of your investments, the next logical thing to do is actually to do the exact opposite and double down and invest more. Instead of seeing that all of your investments have crashed, rather see it as a massive sale to buy new shares and ETFs at a massive discount. The only problem with this strategy is you never really know when the markets will actually start to recover. Buying the dip essentially means pouring all of your extra cash into the market when the market is down. But what happens when you do this and the markets drop even further and even further and even further? This could actually cause you just as much upset and stress as withdrawing all of your funds only to realize your losses once the markets recover. Again, no one can predict the market. So while buying the dip is definitely a step in the right direction, it may not be the best option. So the answer to your question is actually very simple. Just continue what you've always been doing, meaning follow your long-term investment strategy, invest your money every single month into the products or companies that you believe in, and stop listening to the noise in the markets. If you chose to invest in individual stocks or crypto, you are very well aware that they are risky and that they can be very volatile in the short term. But most of the companies whose share prices have crashed are still the exact same companies with the exact same fundamentals. So if you did your research and you stood behind the company before, then continue to do so. But for the majority of investors, diversification is key to long-term success. Even though most of the equity-based ETFs and unit trusts that are well diversified have also suffered, they have taken a much softer hit than most individual companies. A well-diversified long-term investment strategy involves a combination of shares, property, bonds, and even cash spread across both the local and international market, and I explain why this is the case in this video over here. So even though we are living in unprecedented times and that it really sucks to see our portfolios down every single morning, all of this is just part of long-term investing. Over a sufficiently lengthy period, even the biggest drops looks like mere blips in the market's long-term upward trend. Market crashes are inevitable, so instead of seeing this as unfair, rather take the time to revise your investment strategy and allow it to solidify the beliefs you have in both the companies and the ETFs that you chose to invest in. And if you were like me and just bought a bunch of hot stock picks because of YouTube hype and you didn't do your research properly, let this be a lesson to you. Investing is not a get-rich-quick scheme. It requires a lot of skill, patience, and dedication to become a successful long-term investor. You can invest your whole life and still not learn everything. Use your head, not your heart, and focus on the long term. Be humble, make sure your investment strategy is solid, and stop panicking. The sun will shine again. If you have any questions or concerns about the markets or your portfolio, then feel free to drop them in the comments and let's help each other out. This is what this whole community on YouTube is all about. Thanks guys, have a lekker one. Cheers.